In Chapter 9, we talk about money. And in this segment, we're going to talk about the Federal Reserve and reserve banking in general. All right, so we use dollars, and where do they come from? Here's how it works. Jake wants to borrow money from the bank. He wants to borrow $10,000. Thing is, the bank only has $2,500. Only has $2,500 in the bank, but Jake needs $10,000. And so, what do? Well, they make up $7,500 out of thin air. They put $10,000 in his account at the bank. Okay? The bank's column says $2,500, and then all of a sudden $10,000 appears in Jake's account. They approve the loan, and now he's got $10,000. And $7,500 of that came out of nowhere. They made it up. Okay? The bank charges 10% interest, and over a period of years, Jake pays $25,000 back to the bank. The nominal amount of the loan was $10,000. So when Jake pays back $25,000, only $15,000 of that is income. The other $10,000 is a return of principal, and they don't pay taxes on that. They pay taxes on the $15,000. $10,000 of it is return of principal. $7,500 of that $10,000 was made up out of thin air. They got a $10,000 principal return off of a real principal loan of $2,500 out of pocket. See, here's the thing. The trick is this. Normally, they really should be paying taxes on $15,000 plus the $7,500 that they made up out of thin air, because all that's really profit to them. They didn't have it, and now they do. Only $2,500 of it should really be excluded here. Okay? So instead of excluding $10,000, they ought to be excluding $2,500. So that the total amount that they ought to be paying taxes on is $22,500. This does two things. One, it makes banks a lot more money than you think that they're actually making by paying them 10% interest. You think that that's the money that they're making, but it's not just the 10% interest. It's also the $7,500 that came out of nowhere. The other thing it does is it inflates the money supply. The real money supply was $2,500. But now the real money supply is $10,000 after they make this loan. You see, this amount of money comes into the economy just boom. And that amount is 4 times as much as what there was before. It comes to him first. And when he spends that $10,000, it's still worth $10,000. It's only after a certain amount of time when that money trickles out into the economy, the real value of the dollar comes down. What Jake benefits from here is a cash injection into the economy, an inflationary, localized injection. Okay? It's like pouring molasses on a cold day. If you've got molasses in January in a cup, and you're pouring out the molasses into this pile, it comes in a cone like this, and then slowly spreads out into the pan. Same thing with inflationary money in the economy. Jake is the first to get his hands on inflationary money, and so he benefits from it because it hasn't lost its value yet. There's a very special bank that does this on a grand scale. It's called the Federal Reserve. We call it the Fed. Now, what's special about this bank is it has zero money in its fund. It has nothing. And it doesn't lend $10,000. It lends $14 trillion. And you're paying for it. This is the amount of the national debt. The Fed lends money to the government. See, politicians want to spend money because when they spend money, they buy votes. The thing about it is, they can't tax enough to spend the money that they have, so they incur debt. Well, they don't like to have any kind of limitations on their debt, so what they've done is they've created the Fed. And the Fed makes money out of thin air. It has $0, and then it just creates an entry in a spreadsheet that says, okay, here's $100 billion to tide you over this quarter. Or here's $250 billion for the next 6 months. Or here's $800 and some billion for a stimulus. You got to understand who these people are. We don't know who all they are. We know some of them, the ones that have their face on the website of the Fed, but there are several members, I don't know, hundreds, maybe thousands of members. It's a small club, but what they get to do is share in the return on this loan. We're probably never going to pay this back. We can't. There's not enough money. So what we do is we pay interest. Okay, let's just say I don't know how much they charge, but let's say that the government is paying 1% on the $14 trillion that it owes. Pretend that it's 1%. 1% of 14 trillion is $140 billion. $140 billion a year in income that these guys get to split up. You see, because when we pay the interest on the national debt, we taxpayers pay interest annually on the national debt. That is real money. That's money that is created in the private sector that comes out of taxes that are being paid by people who are generating real value and real wealth in the economy, and all those people participate in real money. When you have fiat money, which is just paper, worthless paper money, that is assigned a value by law, then you wind up with $14 trillion debts and banks making money out of thin air and inflation. Lots of it. And that's the problem we have today.